Google is the cheapest tech stock in the market right now, but is it a buy? Is it undervalued, and at what price? Let's take a look. We'll analyze the historical performance of the company. We'll jump into their income statement, looking at their top line revenue as well as their bottom line net income growth with their latest earnings. We'll take a look at their balance sheet, the health of the company, total cash versus total debt. We'll also compare them to some well-known competitors over the last few years, and we'll look at some very important financial metrics you need to understand before investing in Alphabet. And as always, we'll take a peek to see what are the institutions doing. Are they buying or selling? And as always, we will put them through our valuation model, getting to our intrinsic value and our acceptable buy price, given our investor margin of safety. Now, this company has had a phenomenal run, up 48% year to date, some way off that 52-week high, and it does currently have a forward yield of 22.95, one of the cheapest in the tech stock right now. It doesn't currently pay a dividend, and for investors who have been holding this over the last 10 years, well, you would be up 393%. It is a little bit shy off its all-time high from the back end of 2021, where it hit around $150. So let's jump into their revenues. Top line, we like to see 3 to 7% growth year on year. December 2018, 137 billion. 5 years later, their latest annual report, 283 billion. So some incredible growth over the last 5 years. And when we look at that trailing 12 months, it looks to see that December 23 annual report will show some very nice growth. And we can see consistent growth on the top line year on year. And we'll shortly look at the last 10 years percentage-wise an increase too. Also, if you do want to find out their December 2023 results, do hit that subscribe and bell button so you will be automatically notified, and we will release a video for when that drops. Now, in terms of their bottom line, what story does that tell us? Well, 31 billion in December 2018, 60 billion in 2022. So again, double the net income that they had 5 years ago. On a more granular level, we do see an increase to 2021 before a decrease in 2022. And we do see the trailing 12 months showing us a nice sign of an increase from December 2022's results, but still lower than that December 2021. It is something we have spoken about quite a lot when reviewing Alphabet, is they do have the highest SBC, share-based payments, in fact share-based compensation, so it is something just to bear in mind. If you want to take a look in more detail, do check the previous video we did where we did discuss that and compare them to some of their competitors. Now, total cash versus total debt, a quick health check of the balance sheet. 109 billion in December 2018, 119 in their latest quarterly report. So not only do they hold a significant amount of cash, but it has increased by around 10 billion over the last 5 years. And when we compare that to their total debt, what we can see numerically and directionally, it's gone from around 4 billion to 29 billion. So yes, it has increased substantially, but they hold a far superior amount of cash. So really, when we do analyze their net debt to EBITDA metric, we will see that that is fairly zero. Now, year-to-date performance, we do see them up around 48%, roughly the second best competitor, with Meta performing the best at 160.4%. We do see Pin slightly higher by around 52%. Now, in terms of the last 5 years, Google is up 136%, in fact, the best performing in the industry. But as always, just a reminder that past performance is never an indicator for the future. Now, before we look at some of their financial metrics, we can see institutional ownership sitting at 35%, around 50 billion worth of shares sold over the last 12 months, but we can see institutions have been buying a bit more than selling at 60 billion over the same period. And in Q3, we see a little bit more buying than selling, 10 billion versus 8 billion, with the opposite holding true in Q2. Always remember, though, we don't copy what the institutions do, and always do a bit of your own due diligence. Now, in terms of their last earnings, well, Q1, Q2, and Q3 of 2023, we see they beat on both the earnings per share and the top line revenue every single quarter over the last few years. Q4 of 2022, we do see they did miss on both. So 2023 has been very strong for Alphabet. We see on the top line, Q3 23 versus Q3 22, up 11% on revenue, up 41% on net income, and up on every single other metric that we see. So very, very strong performance, significantly better than their performance in 2022. Now let's take a look at some of their financial metrics. Free cash flow per share, 85 cents in 2013, 4.59 in 2022, an incredible run over the last 10 years. And note that 2023 is expected to go even higher, so very positive in terms of their performance on a free cash flow basis. Sales growth, double-digit increases every single year, absolutely phenomenal, although we do see that 2023 is expecting a slowdown, so we may not get that double-digit we have become accustomed to with Google. In terms of sales then, numerically, how does that sound? 56 billion in 2013 and more than 5 times growth on the top line to 283 billion in 2022. If this continues to increase at this rate with that low PE that we see, this could be the best tech stock value right now for the long term. Now, shares outstanding, 13.6 billion in 2013, 13.2 billion in 2022. So we can see they do some share buybacks, very small over the last 10 years. We also note some share issuances, so they did dilute your position as a shareholder. But if you've been holding over the last 10 years, they have roughly bought back around 400 million worth of shares. Now, when we analyze the ROIC, as always, 10% or more, it is what we look for when analyzing the golden dividend metrics, because we believe that it shows management are able to effectively allocate their capital. The last 2 years, in fact, very strong, better than the preceding 8, 20% or in the 20s, in fact, over the last 2 years, with the trailing 12 months, again, 27%. So it does give me a lot of faith when we see the consistency of this strong ROIC. Operating margin, free cash flow margin, very strong, but for those that are looking for companies that have an even better operating margin and free cash flow margin, do go check the Visa episode that we did release today to see what a mammoth company that is in respect of margins. Net debt to EBITDA, very, very straightforward. They had a ton of cash, far outweighing their total debt, which even increased. So this effectively shows us that it wouldn't even take them one day to pay off all of their debt net of cash on hand. So an incredible balance sheet for Google. Now, when we jump into the valuation model, we want to find out what is the intrinsic value. And as always, if you enjoy the content and value is being provided, smash the like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And if you want to grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. So the first model that we typically use is Graham's valuation. However, for Google, it isn't relevant due to the fact that they have double-digit increases year on year. They are a very fast-growing company. So we have their stock ticker symbol just to show you how we'd normally go through. Earnings per share, growth rate for analyst estimates with that AAA corporate bonds yield could give you an intrinsic value. And then we start off with the first model that we are using, which is the multiples valuation model. We have companies in a similar sector and size. We have Microsoft, Apple, Meta Platforms, huge big tech companies with their stock price, earnings per share, PE multiples. I can tell you already without even looking that this is going to be a much higher price as the PE of Google is far below all of these. But what we do is we get the average, multiply that by the earnings per share of Google to get a stock price of 167. When we take a look at that, that is far higher than the current trading price, higher than the all-time high that we saw, and above the 52-week high, showing strong signs of undervaluation in the current market. Do bear in mind, though, we're not looking at any of these models in isolation, and we will draw our conclusions towards the end. Now, the third model typically would be the DDM, the dividend discount model, but as Google don't pay dividends right now, this isn't one that can be used. But let me know your thoughts in the comments below whether you would prefer Google to start paying out dividends or you would like them to ramp up some nice share buybacks. In terms of the discounted cash flow model, it is the fourth model that we're using. We have the free cash flows year on year. We have the average growth rate at 23%. Forward-looking analysts estimating between 12 to 14%. So I have gone more conservative with our discount rate. We get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $161. Again, above the current trading price, above the 52-week high, and in fact above the all-time high that we saw at the back end of 2021. So another sign of undervaluation. As always, the intrinsic value is therefore just the average of the models that we run through, which in Google's case is just these two. And as always, if you enjoy the content, value is being provided, smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. So margin of safety, as always, 10% if you believe it has a wide moat, strong financial metrics, good forward-looking data. A lot of people will argue that Google does justify having that percentage, so it would be a buy up to $147. At 15%, it would be a buy up to $139. And at 20%, it would essentially be at the current trading price. So right now, if you were to buy Google, you would be locking in a 20% margin of safety. Now, personally, Google is one that I hold through many ETFs, but it is also one that I believe in the long-term future. The only issue that I do have with this company is their very high share-based compensation. If you've seen the previous video on Google, we do run through this quite significantly, so I won't touch upon this again. But for me, it is one thing that just really makes it difficult for me to add Google for the long term. However, having said that, with a higher margin of safety, it is one that I would be looking to add around $120 to $123 with a 25% margin of safety, which I do believe it will come down to at some point over the next few months. In terms of Wall Street, well, they believe the share price to have some nice room to grow, lower than our intrinsic value, but around $153, $154. As always, if you want to grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio or your watch list, or even if you want to run through this model again based on your own estimates, do click on that pinned comment and grab a copy. As always, if you enjoyed the video, smash the like button, hit the subscribe and bell button to be continually notified of these videos as they drop. Let me know your thoughts about Google in the comments below, and catch you all on the next episode. Take care.